That's interesting. So, I mean, my own experience with credit unions is when you borrow for a personal loan, it has to be secured. It's a share. It's not really a loan. It's a share secured loan, is what they would like. The municipal credit union does it that way. So you have to have money in the bank in order to borrow against it, and then it's a forced repayment. So, how do you do commercial loans? Is there?
Well, you know, I would say that the you know, experience of credit unions have become more adept and more sophisticated in terms of serving the needs of borrowers while still remaining their, you know, local member-owned, you know, mission-oriented focus. So, you know, most of the, you know, small business loans often will require either personal guarantee or a co-signer in some cases. But you know, it's you know, we look at each loan and each opportunity as you know, an opportunity to be able to help somebody grow financially. Our mission is to build wealth and create economic opportunity for underserved people and communities. And so when someone comes to us and applies for a loan, they can be confident that they're either going to get the loan, or if we think they're not ready, we're going to help them get to the point where they are ready, either by working with a coach to help tighten up their business plan, or to work with one of our credit counselors to get free credit counseling to be able to improve their score, or whatever it is that the person needs to ultimately be successful once they do get started in business.
And Mr. Kirkwood, you also mentioned, it's in your testimony, but you didn't talk about it, but you talked about how for some small business, there's small business applicants, there's a concern, of course, about collateralizing or guaranteeing the loan back to the lending institution based upon their own personal assets, which might, you know, be somewhat of a concern to a small business, particularly a startup.
Yeah, I would say that the majority of business loans made to small businesses have some form of either personal guarantee or a personal asset attached to it. I think that's, I can't imagine a small business going into a situation and not experiencing that in the credit application process. The reality is, credit, depending upon, you know, whatever institution it is, they're going to align their risk appetite and their risk tolerance around, you know, their ability to know that they're going to get repaid. And what you're hearing to me today is that the multiple type of institutions you brought to bear, credit union, bank, NYBDC, a BDC, which is a very specific type of entity, all still have to answer that credit risk question. The real difference in many ways to me is, what are the other things that they're going to do to be able to support potentially extending credit to that small business? And what you hear from CDFIs, for example, is technical assistance is a critical part of how they are mandated and certified, and therefore what they have to deliver. So the reality is, a bank is not mandated to provide technical assistance. We are mandated to give a letter to somebody at the end of a loan and say, you either got a loan with these terms or you're declined. Sometimes we're able to do what we call declination letters that also have attached to it, you did not receive this loan, you were declined for this loan, but also call Tristan over at Alternatives. He may be a potential option for you to borrow. But again, that concept that risk won't change, it's often the differences between what that institution can provide around the risk to be able to sort of say, I can do something more to support you.
Thank you. Senator Sanders?
Don't worry.
Hamilton?
Yes. Thank you for coming, Jay. Thank you, Madam Chair. And can you hear me? Can you hear me now? Yes. I like the concept of community banking. As I mentioned earlier, my mother had started the South Bronx Federal Credit Union, and I have the Brownsville area of Brooklyn. And what we're seeing now is less community banking and more usury banking, where the communities most at risk are being targeted. Payday loans, you know, redlining, credit cards. You pay a payment late, you got to pay $35. So, you know, so it's things, and then you go to a bank for a loan, you get denied the loan, and all of a sudden you get a call from someone else saying, I can get you a hard money loan. So I think, Madam Chair, we have to look at ways in getting back to community banking and getting money to the banks who are actually doing the lending. Sometimes, like I said, Chase Bank is too big, they're not on the ground. Like, you know, Chase Bank, a guy's there 2-3 years and moves on to another branch. So no one's really there to know the community, to know the small business owners. And technical assistance is very important. I think that's important for people who, you know, who do get a loan. and to understand like, what's a reverse mortgage. You know, some people don't, like a reverse mortgage, basically a credit card you're not paying back. And it's just collecting interest upon interest. So depending on how much the interest rate is, you know, you might live beyond your expected life expectancy and your kids get nothing. So there's no generation transfer. So I would like to see more community banking where a person can take out a loan and borrow to maybe buy an item, send their kid to school, and rather than paying 25% interest rate, paying like 8-9% interest rate. And then also keep their credit abreast without having bad credit. So I like the idea of community banking and getting the money to the people who need it. In Brownsville has 60,000 people, only one bank. You know, that's criminal within itself. And so I'd like to talk to you gentlemen about finding ways. I wish we could get more money to the credit unions, you know, and Amalgamated Bank is doing a great job. A lot of folks are saying with ID NYC, other banks are not taking their, letting them deposit their money. Mm-hmm. So Amalgamated is doing the right thing. They're letting people bank at the bank who haven't been banking before. And we have to find out ways how to get banks like your bank more money. Do you guys get deposits, municipal deposits?
We do take some municipal deposits. I was actually going to say, you raised an issue that I think is really critical.
Right.
In New York City, there was the responsible banking ordinance, which to me was a bit different than sort of the normal CRA approach, which has dominated the thinking about how to give back to communities. And there's nothing wrong with what CRA has done; it's been good. But what the responsible banking movement really sort of spoke to, and you know, there are laws that have been passed in Philadelphia, Los Angeles, and other cities, is to really sort of look at the whole role that a bank has, frankly, the whole wallet of the client that a bank is going after, and tie the whole wallet to community engagement. So you cannot get municipal deposits, you cannot get bond business, you cannot get all of these diverse things that also meet the financial, meet the profitability goals of a bank, unless you're making community engagement. So, I mean, it's a thing to consider as well. But I think the other part of it is the thing, and you raised it, is the thing that Tristan and others do, is there are different layers to the banking model, and there are folks who can come in at a point and have a business model that can immediately address, and there's not enough investment in those groups as well. So there's a side where I think there's hold the big banks, hold the commercial banks accountable, which should absolutely happen, and responsible banking ordinance is one way to do it, but also CDFIs, consolidating some of the many programs that exist through ESD and other areas in a way that capital can really have a little bit more leverage and impact for organizations that are mission driven 100% and have taken, the folks that work in Tristan's side of it, they come from the big banks. They're the same underwriters, they're the same credit officers, they're the same professionals. They know how to do exactly what the big banks do. They're just not resourced at the same level. But yet they're 100% there because they're trying to drive lending and trying to drive services at the most community level. And there's both sides of that need to be supported.
So in New York State, do we have a responsible banking approach, or we don't have it at this point in time?
From what I understand about New York State at this level, it's just there's a CRA mandate that exists at the New York State level, which is similar to the federal CRA mandate. Right. But what I'm speaking about is more localized, to sort of say that there are levers that can be pulled at the most local levels that can be tied to community investment and community re-engagement as well.
I like that. I want to talk to you after we get finished here, because both of you brought up a lot of great points that I think we need to explore more, and we need more time to explore it and talk about it and see how we can integrate it. Because it seems like we have the information and knowledge. It's just a matter of implementing it in a wise fashion. I know Patrick was here earlier, and he was saying, we're doing a lot, but the previous group saying he's not doing a lot, and what you're saying is it makes more sense on how to get the money into the community with local banks and figure out what the mission statement is, and then have a holistic approach. I didn't hear that earlier. So what I'm hearing from you, I like it a lot. And so I'm gonna work with you a lot to make sure we do what we have to do for our communities, to get the small business guys up and running, hire local kids from the community, and let's because New York City is vibrant, and the people just need opportunities to have access to finance. You know, and once you have that, you know, it's an even playing field. So I like what both of you are saying, and I'm happy that you're here today.
Thank you, and thank you. And as I was listening to your comments, it struck me that, you know, my organization was explicitly created to meet an unmet need that wasn't being filled by the banks in our community. And as you're talking about, you know, kind of the what you call community banking, the 300 credit unions across New York are really filling that niche at a local level. And certainly community development credit unions, CDFIs, are, you know, in the most underserved areas, you know, fulfilling that responsibility. And New York did pass enabling legislation back in 2007 to create a state fund that's modeled after a federal program we're part of. But unfortunately, it's never received a dime of appropriation. So I think there is an opportunity for us to talk further about ways in which, you know, state, you know, your support could really be leveraged to help us make a greater impact in the world.
Thank you. And you know, I forgot to mention, you both talked about the problem of the lack of community banks in communities. We, you know, as the chair of the banking committee, I've struggled with this for the past 2 years. This is a real problem. That they are the entity that really was created for the express purposes of providing banking at the local community level and access to credit and capital at the local community level, especially for small businesses. They are not doing that. We have struggled with this for a while to try and come up with a solution, but they'll be the first to tell you that they don't have the assets to be able to do that kind of lending, and I don't know how we help create that. But what we're hearing here today very clearly is there's the big banks who are risk averse with respect to this population of lending, have created an environment to put money in, but nobody seems to know about it. And then when you do find out about it, you can't access it. When you try and access it, you're told, you know, no, and then you guys are trying to fill the gap. So information is always important, and a lot of people just don't seem to have it, and they don't know where to turn. But I'm going to ask you guys the same question that I asked previously. If one of the MWBE applicants walked into Amalgamated Bank and they weren't, you deemed them not a good credit risk for whatever reason, and that you wouldn't be able to help them, is there someone there that then tells them where they can go to be able to apply for the kind of lending that would suit their small business startup?
So the honest answer is no.
Yeah, say?
It's a bit of a thing where banks don't like to speak and take on situations where they feel like there's some liability associated with.
Interesting.
How they communicate with a client post declining them, because it's supposed to be a very sort of objective process in extending credit. I did mention that there are cases where a bank can, if they're in partnership with, let's say, a nonprofit partner, a community development corporation, a community development organization, they can do something called a declination, where they say, look, we're declining you, but we're also sort of giving you a list of potential partners that you could go to talk to. Or they can go and say, you know, the New York City Small Business Solutions Center might be an alternative for you to go to talk to, but it's not a common practice, and it's a problem, right? Because you're basically saying to a whole host of people who need credit and are most challenged to finding the credit that, you know, the buck kind of, there's no outlet past the conversation you're having with the bank.
And the problem then is they're probably going to wind up turning to the wrong lender.
Loan sharks.
Well, loan sharks, whoever, because they don't know that there's actual resources available to them. And when you're, look, I can't even imagine, but if you're trying to start up a business, you have a million other things you're trying to juggle. Now you literally send someone out there and say, go find money. It's not that simple. I think that might be one of the definite suggestions that comes out of this hearing. There's got to be a way of making sure that people know. 2 years ago, I think it was 2 years ago, in the never-ending issue of foreclosure prevention efforts, we had the state took the step of funding local legal services to help people deal with the potential foreclosure problems, so that they could have representation if they were under a certain income level. And then we found that many of the bad actors that we had driven out of the mortgage industry had repurposed themselves as foreclosure prevention experts. and they were charging, they were, you know, advertising saying, facing foreclosure, call us. And you went in there, and of course they took all sorts of money off of people who were already in serious financial distress, and then not doing anything to help them. So we had to take the next step of requiring everybody in this industry now must post clearly, you are entitled to this information for free, and here's who you call. I would hate to think we would have to do that in this situation, but perhaps we might want to require banks at all levels to say, we can't, you know, provide the lending that you need. However, here's where you can go, and you're able to access that information. I think that's certainly a simple solution. I'm sure the banks will dislike that, but you may dislike it too, because it's one more step. If there's a concern about liability, obviously that's a discussion we can have post-hearing to talk about what we can do. We have, before I hand it back, we are very shortly going to be confirming the new superintendent of financial services, Maria Vullo. It'll be coming up very soon. This may be something. June 8th. June 8th. See? No time like the present. I think this is probably going to be one of the many things that we're going to talk to her about. How we not only close the gap, but make sure people know what good of programs that the state is investing in and funding, and we're forcing banks to participate in if nobody knows they exist, right? Doesn't seem to make much sense. That's just my own personal take.
But the responsible banking approach, which city or state has it worked at?
So Los Angeles passed an ordinance in 2013. You can definitely not only see the ordinance, but 3 years now of action. I'm sure there's had to be some reporting by institutions under that. Philadelphia has had one, I think, close to 7 or 8 years now, so I'm sure there's some data on that. And Cleveland, I believe, I'm getting a little foggy, but I believe Cleveland.
Los Angeles would be the key, the best one to.
Los Angeles is probably one of the better ones to use, just because of the size and scope. You can kind of compare it to New York City, what it looks like to be a large scale GDP to look.
And one more question. I'm sorry, it just occurred to me, because you both mentioned the cost associated with servicing accounts like this, and there is an associated cost. Banking doesn't come free. This is an issue that I've heard with respect to medical marijuana. Many of the banks, even though the federal government says you can process the accounts and you're allowed to service them, there's a tremendous cost associated with processing accounts like that. Is that one of the barriers, though, to lending to MWBEs and small businesses in general, the excess cost associated? So would that be one of the reasons why a bank might say it's not worth it for us to participate in this lending?
Not so much cost, and you may have a different experience, but not so much cost in terms of the servicing of the account. I think the cost structure is really more affiliated with the cost of reserving and sort of setting a risk level associated with that account. So the reality is, what if you look at the majority of what commercial lending looks like, it's real estate secured lending, or it's some sort of collateralized lending. So essentially it's adding some form of security, collateral, guarantee, or whatever into the mix to essentially so the bank does not have to assume that it's holding as much in reserve against the potential of a loss. So that's where the cost is associated with. So it's much cheaper for me just to lend against a building that if it forecloses, I can foreclose on the building and it has value at some level equivalent to the loan that I made, versus lending directly to a small business who's cash flow driven, and if their business does not succeed, obviously there's nothing to recover against in the loan. And that's quite simply where the cost to me comes in. It's not so much you have an account and it costs you to service the account, because more than likely you're getting paid to service the account also. So,
but that's an additional cost into the customers.
Yeah.
So it would be probably
right. So for the customer, definitely you're right, it's punitive, but for the bank, it's not punitive to necessarily service the account. It's really against the risk associated with the lending.
But then that's just another impediment to the MWBE, because it costs them more money to borrow money.
Right.
And our answer to that question is kind of tied into the answer to your earlier question, which is, well, what happens when somebody walks in at a WMBE and says, I need a loan here? And so for us, the experience is completely differentiated than what would happen if you walked into your typical commercial bank, because our model is to take people who are often unbanked and on the fringes of the financial system and help them through successful experience with our products. and programs become successful savers, borrowers, and ultimately owners of assets like homes and small businesses. So that person coming in would have access to a small business counselor through our Business Sense program, who'd be able to help evaluate ideas, help write a business plan, prepare somebody to succeed, either one-on-one or in classroom format, have access to free credit counseling to be able to become more creditworthy if their credit score is an impediment, and just have access to a supportive network of other entrepreneurs that we've helped as well. So it's a very successful service delivery model. We're very proud of the many businesses that we've helped launch, but it is a very it's often a sort of a challenging business model to be able to maintain, especially absent some of the sources of funding that optimally we would want to see. That said, because we're mission-based, we do this work because it's what we're here to do.
Thank you. Senator Hamilton, do you have any more questions for them?
No, I just want to say thank you both for coming. For me, it was informational. I look forward to working with you, with the chairwoman, and with Senator Klein to figure out how to get more funding for community banks. And I think that's the way to go at this point in time for myself.
Thank you, gentlemen. And our final presentation is from the Black Institute, Bertha Lewis, founder and president, and Mr. Martin Lockman, sorry, I should put my glasses back on, research policy associate at the Black Institute. And I would say we have been joined by Senator Klein. Excuse me?
Jason Jetter as well.
Oh, I'm sorry, and Jason Jetter, also from the Black Institute. We've been joined by Senator Klein, the leader of the Independent Democratic Conference, co-leader of the Senate. And do you have any comments you want to make, or you'll wait for testimony? Okay.
Don't make you all official.
No breathing. I'm assuming that you will go first, Ms. Lewis.
Well,
Or you want to go last? It's up
we're
to you.
going to save time. We won't go through their testimony. I'll be the only one testifying. But, we're here for data, and we like to give numbers. So if you have numbers, my numbers men are here. So first of all, for those of you who don't know me, I'm the founder and the president of the Black Institute, and we are an action tank. We are a think tank that takes action, and we address economic, environmental, education, and immigration policies through the lens of their impact on communities of color. I'd like to start off by saying really, truly heartfelt thanks to New York State Senate Banking Committee, especially our chair, Senator Savino, for having us here today. The leadership of this committee and the dedication its members have shown to addressing these critical issues set the gold standard for which voters should hold our elected officials. Finally, and most importantly, I'd like to thank the business owners who took the time out of their busy day and their schedules to tell their stories. Although each story of discrimination is an outrage and a tragedy, no one in this room can honestly claim to be surprised. The truth is that today, in one of the most diverse states in the country, a state that boasts more than 1 million minority and women-owned businesses, the stories of discrimination and neglect that we've heard are not unique. They are business as usual. And all MWBEs, I might add, are not small and tiny. Small businesses. I think those two get mixed up, and words have a lot of power and a lot of meaning. So I'd like to make sure that we clarify that. This is not a new issue for the Black Institute. In 2014, as some of you may know, we launched our Fair Share campaign for MWBE equality, and in early 2015, we released our MWBE report, Not Good Enough, focusing on discrimination and disparities in public contracting. We followed that report with a town hall tour of New York's 5 boroughs in collaboration with the Women's Caucus of New York City Council. Across the 5 boroughs, we met with more than 200 business owners who were struggling to get in the door on public contracts. In response, we released a short report called We're Serious and We Are Not Alone, recommending solutions to contracting disparities at the city level. These recommendations were incorporated into legislation by members of the New York City Council. And there are committees on women, small business, and contracts. However, none of this legislation touched the heart of the problem. Capital, credit access. It's all about the money. Ain't a damn thing funny. It really is true. Throughout our research and conversations with MWBEs, we frequently encountered many of the same concerns. Discriminatory loans, indifferent or hostile lending personnel, predatory interest rates. In response to those issues, we released our latest report in April of this year, Access Denied, MWBE Capital and Credit Discrimination in New York. In it, we detail the issues of credit and capital access. The disparity in credit access has never been clearer. Today, across the country, a firm is more likely to be denied credit when it is a minority owned by an order of magnitude. Businesses owned by a woman is only half as likely as one owned by a man to successfully receive a business loan from a bank. Facing a systemically discriminatory credit market, many MWBEs have come to rely on personal credit lines of their owners. A 2012 survey by the National Federation of Independent Businesses revealed that 19% of small business owners fund their businesses through the proceeds from a mortgage. Hispanic and African American owned firms are more likely than any other business to rely on owner equity, such as mortgages for startup capital. Across demographics, women-owned firms are twice as reliant on personal debt as the average firm. This reliance on personal debt is one of the main reasons why Black, Hispanic, and female entrepreneurs start their businesses with less than half of the capital of non-minority men. When we talk about the economic redlining that is going on, and it is driving New York's MWBEs into bankruptcy, we need to look at banks like Chase, Citibank, Wells Fargo, Bank of America, and the US banks. Why am I focused on them? Because every one of the banks I've mentioned is part of an elite, exclusive club known as the New York State Depository Banks. These banks handle state funds. They are our bankers. They are where our checking accounts are and where our investment accounts are. And they receive in fees over $900 million annually. That's almost $1 billion with a B. In payments, low to no interest rate credit for New York taxpayers. And at the same time, these banks dominate credit markets. The 4 largest depository banks for New York State, JP Morgan Chase, Wells Fargo, Bank of America, and Citibank, jointly control almost $7 trillion in assets. In 2015, their average quarterly commercial and industrial loans topped $500 billion. In 2015, 63% of New York small businesses seeking loans or lines of credit look to large banks. Risk averse indeed. when you have trillions of dollars in assets. Given the enormous role that banks like Chase and Wells Fargo play in the commercial and industrial capital market, it is impossible to talk about capital access for MWBEs without discussing the persistent, widespread patterns of discrimination present in New York State's depository banks. Wells Fargo was forced to allocate $175 million to 4,000 African American and Latino borrowers in 2012 because they forced them to have discriminatory and abusive loan terms from 2004 through 2009. The bank was also accused of steering minorities and to subprime loans with higher loan fees over a 5-year period. Subsequently, the city of Los Angeles filed a lawsuit against Wells Fargo in which it exposed the bank's history of providing loans to minorities that were outside of their economic means. Similarly, Bank of New York and JP Morgan Chase each have faced numerous legal disputes that charge the banks of disproportionately forcing minority borrowers into accepting subprime loans. Bank of America faced 3 separate lawsuits in 2011. Bank of America was accused of forcing subprime loans on many individuals. The city of Chicago and the city of Los Angeles followed suit, accusing the bank once again of similar predatory practices. In their lawsuit against the bank, the city of Chicago claimed that Bank of America executed racial bias in almost 100,000 cases of loan distribution. It's been reported that 60% of these loans were given with the knowledge that borrowers would have a high risk of default. So I could go on and on about JP Morgan and all the nasty banks that, quite frankly, disrespected this body by not showing up here today. And so I think there has to be some accountability when we are paying these same banks exclusively $1 billion a year. In our testimony, we have instances of these depository banks that have much higher interest rates. And the bank-by-bank data on loans to minority and women-owned businesses is hard to come by. We had bankers sit right before you today and tell you that they could not give you data because they do not collect it. And if they do collect it, the data is such that it has to be hidden because we had 6 researchers trying to find it. I mean, you have to be an archaeologist to try to go below their numbers. Neither the federal nor the New York State Community Investment Act requires the disclosure of business lending demographics. Still, as much as these large banks try to hide it, there's plenty of evidence that there is prejudice in commercial and industrial credit markets. A 2013 survey of access to capital by the United States Small Business Association found that Black and Hispanic business owners were 3 times more likely than white business owners to not apply for a loan out of fear that their loan would be denied. Of the business owners who did apply, Black and Hispanic applicants were half as likely as white applicants to be successful, while acceptance rates for women trailed men across every racial and ethnic group. Given this widespread and long-standing redlining of our business communities, it's easy to understand why MWBEs are reluctant to apply for loans from these discriminatory banks. Overwhelmingly, businesses chose their funding sources based on existing relationships. Why should minority borrowers turn to banks that they know to be hostile? The predatory nature of New York's large banks explains the incredible companies that didn't seek financing in 2015. 23% have been discouraged from doing so. Twice the rate of businesses in Connecticut and Pennsylvania, only 48% of New York businesses who applied to a large bank for financing received it, and 67% received less than they requested, a higher rate of underfunding than any surveyed state except Florida. 30% of those businesses were unable to meet their business expenses because of it. The discrimination is forcing our community into poverty and debt. The gross number of banks involved in the abusive treatment of MWBEs requires immediate action from government and an unyielding commitment to bank accountability. We need to send a message to these depository banks that discrimination and redlining will not be tolerated. Earlier today, many of you have asked for a solution. This may not be a solution, but it is one solution. We agree from a study that our colleagues at the Center for Urban Future in their latest studies that we can improve upon existing business development programs for MWBEs. Counseling and mentoring is an essential part of any long-term solution. Now I'm going to go in the Wayback Machine. Before I founded the Black Institute, I actually was a mortgage and credit counselor. I actually crunched numbers and did underwriting. And we actually counseled first-time home buyers so that they would come to us and we would figure out how to get them credit worthy, which really kind of upset me today. Let me just say that in the mortgage crisis, Acorn counseled folks who bought houses had a 1% default rate in this great recession. It works. So these efforts also require transparency, honest partners, and a real and substantial commitment of time and resources from ourselves, from the government, and from the banking partners. Everyone in this room knows that we cannot trust these predatory banks if they are left to their own devices. And in that program, yes, indeed, if you walked into a bank, one of the biggies, and asked for a mortgage, and they, for whatever reason, said, no, you can't get it. Guess what they were required to do? To tell you, here's a brochure for you to go to mortgage and credit counseling, and then they'll get back to us. It can be done. It can work. Businesses are going under every day from discriminatory lending, and we can't afford to allow counseling and mentoring to take the place of real action, however. New York's MWBEs don't only need programs, they need resources. It's easy for a policymaker and politicians to slap their name on a program and pretend that a program has solved the problem. We've seen it. We've seen it time and time again. In fact, we saw it earlier today. The mailboxes of every MWBE in this room are groaning under the weight of program pamphlets. Mentorship programs will help some MWBEs over time, but they do not cut to the immediate problem facing all MWBEs, access to credit and capital. It's easy for politicians and policymakers to promise meetings. New York Mayor Bill de Blasio promised in front of 50 minority developers to hold a banking summit on this very issue. That promise was made more than 7 months ago. In those 7 months, not a single banking meeting has been held. Not a single dollar has reached an MWBE from these predatory banks that they didn't have to beg for. New York's MWBEs can't wait 20 years, and they can't afford to wait another 7 months for de Blasio to take action. The New York State legislature must amend the New York State Community Reinvestment Act to require transparency and fairness in business lending, not just personal banking. And Governor Cuomo must convene a summit of this exclusive club of depository banks that receive almost $1 billion of our tax money every year and secure their commitment to creating an additional $1.6 billion of fair rate credit for minority and women-owned businesses. They can put that fund together. $2 million, $3 million, $1 million security for a $250,000 loan is absurd. So therefore, since they have trillions of dollars in assets and they charge us $1 billion a year, let them pool their dollars and come up with a $1.6 billion fund. I want to close by thanking all of the state representatives and the business owners present for their time and commitment. Everyone in this room today is here because they know that New York's economy was built on the backs of women and minorities. MWBEs contribute more than $200 billion every year to New York's economy, but we are constantly relegated to sharecropping for predatory banks. What we are demanding are fair credit opportunities for MWBEs who have long been shut out from a fair share of the wealth that they themselves created.